Like any investment, investing in the share market has a risk and reward relationship. And so it's important to be aware of the different types of risks at play when investing on the ASX. To discuss identifying and managing risk, I'm joined by one of Australia's best-known independent economists, Saul Eslake. Saul, thanks for joining me today.
That's a pleasure. Thank you for having me.
Now, Saul, in the current trading environment, what are the key risks associated with investing in shares?
One of the key risks has been just how stretched valuations of shares are. That is to say, price earnings ratios are high, especially relative to interest rates. And that's perhaps less of an issue for Australian shares in general than it is, for example, for US shares, although the valuations of bank stocks in particular, which represent a very large proportion of the ASX, have been particularly stretched until the recent correction, in particular the largest bank stock has undergone. But what that's telling you is that the markets have been, at least until the past couple of weeks' corrections, been pricing an awful lot of good news and haven't been making a lot of allowance for bad news. And as we've seen over the last week or so, there's now an awful lot of bad news that is starting to be priced in. And I suspect that there is more to come. Investment is always about balancing risks and returns. Sometimes the highest returns can be found by taking on risks that are well timed in terms of market circumstances. But it seems to me that in the 3 or 4 months leading up to the peak of a couple of weeks ago, markets had been pricing in an awful lot of good news and not making much allowance for risk.
The ASX briefly hit correction territory on Wednesday and today clawed back more than 0.5%. What do you think's driving the decline in the market?
I think it's uncertainty about the outlook for economic policy, not just in the United States, although that's the epicenter of this uncertainty, but uncertainty as to the impact that what the Trump regime is doing in the United States is going to have, not just on the US economy, but other economies, and how other economies are going to respond, or as they sometimes like to say, retaliate. Most mainstream economists would say that the kind of things that the Trump regime is now doing in the United States, that is to say, imposing substantial import taxes that will be paid by American consumers, not by foreigners, booting out a significant proportion of its workforce, particularly workers who work in industries like food production and cleaning, that American workers don't want to do, making potentially large cuts in government spending in an unstrategic and chaotic way, and possibly adding to an already very large budget deficit at a time when the US is, at least for now, close to full employment, that these are crazy things to be doing. In addition, because they are being done in such a chaotic way, one day there are going to be tariffs on, for example, Canada and Mexico. The next day, some of those tariffs won't apply to certain goods. The next day, the tariffs might be postponed for a month. And then the day after that, they're back on in full and being extended to more countries. What that's doing is creating an enormous sense of uncertainty on the part of both businesses and consumers. And what we know is that when people or businesses are uncertain, they put off making decisions. They put off, if you're a business, making decisions to increase investment, to open new plants or buildings, to put on new employees, to venture into new markets. And likewise, householders, when they're confronted with uncertainty, including uncertainty about whether they'll have a job next week, will put off major spending decisions, whether it's to buy a car or a house, or maybe even to go on an overseas holiday. And that's where the risk of recession that is now roiling stock markets is starting to come from. Once financial markets had come to the view that Trump was going to win the election last year, which they did around early October, the general sense in stock markets was that although Trump's tariff policies could add to inflation, his deregulation and tax cutting agenda would boost economic growth and corporate profits. So we had what was described as a Trump bump. But shares rose significantly. And the assumption that people made was that Trump would be pleased about that and take it as an affirmation of his policies. Well, what's happened since 2.5, 3 weeks ago is that as the markets have come to the view, first, that Trump's policies are going to have a negative impact on economic growth and profits. And second, that he doesn't care about the impact that that's having on the stock market, which is a surprise to most investors. The mood has turned much darker. And so, as you say, the US market in particular is in full-blown correction territory. And while that doesn't necessarily represent a reliable forecast of what's going to happen to the US economy, there have often been corrections in the share market that haven't been followed by recessions. Nonetheless, when you look at what's driving it, the chance of a recession in the United States, although it might not yet be over 50-50, is certainly more than zero and rising. And what's particularly concerning is the way in which US economic policies are being deployed with the intention of harming other economies, including, from an Australian perspective, importantly, China, at a time when China's economy is struggling in a way that it hasn't for a very long time, is a very significant risk that this will spread all around the world in the way that, for example, the tech wreck recession of 2000 was largely a US event.
In your view, what's the relationship between the volatility of share markets and higher returns when compared to safer assets like cash?
As a general principle, long-term investors are willing to make that trade-off. Most investors, superannuation funds in particular, but ordinary investors who are investing with long-term horizons, understand that roughly 1 year in 7, they're going to get negative returns. But they also understand that over, say, a 20-year horizon, the years in which you get positive returns and the returns you get in those years when they're positive will substantially outweigh the losses you suffer in the 1 year in roughly 7 that you get negative returns. And, that's why people with long-term investment horizons are willing to accept those risks and put most of their money into stocks or similar assets. Times of great risk, many investors will reduce their exposure to equities and move into what are meant to be safer investments like US or other government treasury bonds or even into cash. The mistake that a lot of investors make, of course, is to do that after markets have fallen. We saw that particularly during COVID when the government, I think rather foolishly, encouraged people to take money out of their superannuation savings. And of course, they did that at the bottom of the market, and the long-term consequences of that are very substantial. And, there's an old saying that it's not so much timing the market as time in the market that delivers returns for long-term investors. So if you are a long-term investor, you need to be willing to look through the kind of volatility we're seeing now. If you're a much shorter-term investor, well, it's a much more difficult decision, and the risk is that you can make some serious mistakes.
And how can investors best mitigate the major risk scenarios that we're seeing right now?
Well, one option is diversifying. Is always a way of reducing risk. If you think that the US economy is going to be at the epicenter of the Trump-induced recession, then look for alternatives outside the United States, and maybe in particular, look for alternatives where markets have already extracted a high price, but where you have confidence that the governments of those countries are going to pursue sensible economic policy. Now, Australia might be one of those. It's encouraging, I think, that our government is saying, in response to the unfriendly act which America's decision to impose taxes on our exports of aluminium and steel represents, and the possibility, as we've seen in recent days, that might be followed up with tariffs on more important exports to the United States, such as beef, lamb, and pharmaceuticals. Our government is, I think, quite correctly saying that they're not going to respond to policies that will force Americans to pay higher prices for Australian imports by forcing Australians to pay higher prices for things imported from the United States. That's, as I often say, circular firing squad stuff. It's stupid. We didn't do that when China sought to coerce Australia by imposing higher tariffs on our exports of barley, wine, lobsters, and coal. And we didn't say, well, if they're going to do that, we're going to force Australians to pay higher prices for a considerable range of things that we import from China. Instead, we're going to help our exporters find exports in other markets to diversify. And I think that's part of the approach. I mean, if you really think this is going to go on for a long time and that, the consequences are going to be much more serious than the ones we've seen already, then it probably would make sense to reduce your exposure to equities overall and look for some alternative asset. If you believe, for example, that what Trump's doing is going to result in higher inflation around the world, then even though gold is approaching $3,000 an ounce, it still might make sense to buy some, not all, to put some into that. You wouldn't necessarily put money into US Treasury bonds if you think that the US is going to be running substantially larger budget deficits, as it may well, or if you think that some of the shine on the US dollar as the world's principal reserve currency is going to be rubbed off by the perception that the lunatics have taken over the asylum. You might rethink the conventional view that in times of trouble, the US dollar and US government bonds are a safe asset. Maybe instead you think about German government bonds or Swiss government bonds, for example, or gold as alternatives to that, if you believe that this is not just a passing storm, but that there are real significant further amounts of downside for US shares. And if there are for US shares, then inevitably there'll be for shares in Australia and other countries as well.
Now, the Australian budget is coming up, as you know, and what policy approaches do you think will help the economy navigate these uncertain times?
Well, I suspect the answer to that is not the policies that we're actually going to get in the budget. What this budget will essentially be about is shoring up the government's prospects of retaining its slender majority at the forthcoming election. We'll probably see another round of energy bill relief, especially after the announcement this week that electricity prices are going to go up quite a bit again this year. The government will want to make sure that individual households don't face additional pain as a result of that. Of course, the government's already announced some other big spending policies in relation to Medicare, for example, that they reckon that they've already funded in the so-called contingency reserve in the budget. I don't think we're going to see the kind of policies that I would like to see if Australia were to meet some of the serious challenges it does face. And let me just mention three. One is that it's very clear the Australian people want more spending on health, aged and disability care and probably childcare as well. And that they've also made it clear that any party aspiring to be in government who says they're not going to meet those expectations isn't going to be in government. We have to figure out how are we going to pay for that. And I find it hard to think of other areas of government spending that can be cut by a sufficient amount to avoid the need to think about raising additional revenue in some way. The second thing is that it's quite clear as a result, not only of the changing international security environment, but particularly as a result of the growing awareness that we cannot rely on the United States to defend us in the event that we do come under attack. And countries in Europe and Canada and Japan and Korea are coming to that realization as well. We're going to have to spend more on our defense, and that has to be paid for. I don't think the government is going to say that in the forthcoming budget, but at some stage, Australia is going to have to come to terms with the need to spend more on defence, and that means we're going to have to think about how we're going to pay for that more spending. The third thing, I think, is that Australia, like many other Western economies, is experiencing a productivity crisis. Productivity growth, which ultimately is the only sustainable source of improvements in people's living standards over long periods of time, has been abysmal over the last 10 years. Now, we're not Robinson Crusoe in that regard. Lots of other countries have experienced it as well. But we need to be thinking and doing things that would lift our productivity. And there's a range of things that would help in that regard, including improving the performance of our primary, secondary and tertiary education systems, doing things about the decline in the dynamism of our economy, the rate at which new businesses are started, the rate of innovation, the extent to which workers can move from low-performing firms to better-performing firms or to higher productivity industries. There are a lot of things that could and should be done in that space, but not many of them are being done, and I don't think that we will see many of them in the forthcoming budget. Sadly, nor do I think we're going to see either of the major parties making promises to address these challenges between now and whenever the election is called, most likely for one of the first 3 Saturdays in May.
Saul Eslake, thanks very much for joining us on Hot Copper.
That's been an absolute pleasure. I hope we can do it again sometime.